Good evening, everyone. Happy New Year, first and foremost. My name is Patrick Chang, and I'm the Chief Investment Officer for CIMB Bank. On my left here is Boon Ho, the Head of Fixed Income, and on my far left is Mabel, my Head of Fixed Equities. Sorry. Without further ado, let me just introduce what we're going to talk about today. But before we get there, we want to actually have a quick recap on markets going into 2025. 2024 was a very exciting year for markets itself. First and foremost, we had a second year running where equities actually outperformed fixed income, gold actually outperformed, and most importantly, we've had Donald Trump coming on board to be the president-elect for the United States. A lot of market participants call it the Trump 2.0, Trade 2.0, we call it Trump 2.0. Now, what does this really mean when you think about Trump 2.0 in terms of the outlook that's going on? Will equities continue to outperform fixed income? Let me first address this by asking Mabel, do you too anticipate equities to outperform fixed income 2025? What's your outlook?
Yep. We are positive on equities. We believe equities will outperform fixed income this year. Having said that, we don't expect the performance to replicate that of 2024, whereby equity markets are very bullish. So we are starting the year on a higher base. You should temper your return expectations. Within equities, we are positive on the US, we have an overweight, and we are neutral on China and ASEAN.
Right. So effectively what you're saying is that this whole momentum in terms of what we call US supremacy, or indirectly, a lot of market participants call it the US exceptionalism, will continue. Now, what does that really mean, layman-term? What does this big word called exceptionalism really mean when you think about the US economy and the markets?
You know how in the past decades, the US has always led in terms of growth, innovation, economic landscape and all that. So that's basically what US exceptionalism means. Everyone focuses their attention there because they are the market leader in global economy, stock markets, and so on. We believe that will continue this year under Trump 2.0.
Right, okay. But essentially, does that really mean that, a lot of people talk about the US market being extremely expensive at the moment at 22 times PE. And yet you are saying that this whole phenomenon, US supremacy or exceptionalism will continue, markets will be more buoyant. How do you drive all of this when you think about one of the most expensive markets, particularly the NASDAQ?
Okay, so I think with President Trump coming on board, there are some campaign promises that he has that will drive growth for corporate America. So for example, he's going for higher tariffs in order to protect US businesses. He also wants to reduce corporate taxes. That will be a boost to corporate earnings for the US market. And thirdly, he's talking about deregulation. So lesser compliance costs, more innovation for the US companies. I think all of these is going to drive more growth for US corporates. And that's why the US trades at premium valuation.
I suppose what you're saying as well is that this is going to be something where relative to the rest of the world, the US is going to basically do better economically as well as financially as well, right?
Yes.
Now, on that background itself, typically when you think about an economy like the US, which continues to grow, effectively, it also means that inflation potentially could be higher, especially when in the advent of higher tariffs as well. Now, do you have a view of how do we see fixed income going to 2025? And particularly, maybe you can shed some light on, views in terms of how you see tariffs impacting inflation.
Okay, so tariffs, if it's fully implemented as what the campaign promises stated, will certainly be quite damaging for the inflation US. And there could also be inflation impact globally because tariffs will tend to actually suck in a lot of imported inflation, and dollars will tend to be also US dollar being strong. A lot of imported inflation will flow into other countries around. So that said, we think the fixed income market could actually be quite concerned, especially in the first half of this year. And we would expect a lot of volatility in the market, especially hitting the longer tenor bond. But we think the second half, we could see a comeback as most of this.
And this is the 10-year and 30-year, right?
Yeah, this is mainly the 10-year and the 30-year. Specifically, the 30-year will be more impacted. So we need to be a bit more careful, especially in the first half of 2025. But as I said, the 2025 also has another silver lining, is that we think the second half of 2025, fixed income could actually have a comeback because a lot of the policies, uncertainty of implementation, tariffs, tax cuts, could actually already be played out and factored in by the markets. By that time, the policy rates for the Fed will continue to be cut. And therefore, we think that a lot of the bonds which have actually taken exit in the first half could actually make a comeback in the second.
Wow, there's a lot to chew on that one.
Yeah.
But effectively, if you had to nail it on the ground in terms of strategy, what you're saying is that, if I hear it correctly, is that the first half itself, basically, we do anticipate yields go higher, because of the higher inflation expectations. At some point, there's going to be a lot more value in the market. Is that how you should read it?
That's right.
And then that's where you actually go out there and start to invest even more.
Right? So I think in the second half, particularly, the opportunity will come in the form of income investors also. Because as yields rise in the first half, then in the second half, investors who are more into income approach would actually like to actually lock in some of these yields higher and longer. Because higher for longer doesn't only look at 2025, it looks at longer tenor. So you will be actually quite advantageous for income pacing.
Based on that view as well, maybe just want to add one more question to Maple as well, is when you think about higher for long, obviously it will challenge valuations, particularly in the US market itself. Now, does that really mean to say that the US market could get more volatile from here on?
Yes, we think so. In fact, elevated valuations has been a problem for the US market for some time. And that is why we are not going all out and saying buy at any price. We are quite mindful of valuations. And we think that if there's any market correction, that will be the opportunity to position for growth.
Right. On that note, maybe we shift gear a little bit to the nemesis of the US, which is China. Right. And you know that China basically is in the middle of the crux of this trade war that is having over the last 4 or 5 years. But despite that, last year itself, on the back of more stimulus expectations, the HSI and the HCI was up by, if I'm not mistaken, 23% and 31%. Now, is all the good news being priced in by this whole potential economic recovery that we're anticipating in China? And how do you see China?
Our view for China is actually neutral over the longer term. We are still concerned about some structural challenges that they have, like rising youth unemployment, oversupplied property market. But in the near term, I would say that valuations look quite attractive. We think the market may have reached a short-term bottom. Right now, everyone's very focused on Trump's threatened tariffs on China and potential export bans and so on. So this is causing a lot of volatility in the Hang Seng Index. We think tactically it could be a short-term buy, a short-term trade, but longer term we are neutral on the market.
Right. Okay. And what about ASEAN markets? In your previous chat that we had last quarter, we were quite constructive on ASEAN. It sounds like you're a little bit more careful or a bit more mindful of risk now in ASEAN. Why does that change?
One main factor, and that is the strong US dollar. So typically when the US dollar is strong, that's a headwind for emerging markets, including ASEAN. And we think that could temper portfolio flows into the ASEAN region. But having said that, actually in places like Malaysia, we do have domestic resilience, domestic growth drivers, and a China plus one strategy that could offset some of these effects.
So it sounds like you're more constructive in Malaysia within the ASEAN context.
That's right.
Right. And on the back of this China plus one, FDIs, and more favorable policies. Right. But Malaysia has already outperformed last year. What makes you think that it's going to continue to outperform again? What's the drivers of the Malaysian equity market that you see in 2020?
Actually, the drivers are quite similar. So if you're looking at domestic growth, I think government policy has been very supportive. We're giving a lot of incentives to attract foreign direct investment to come in. people are coming in to invest in data centers, semiconductor factories, more construction projects are being rolled out, things like that. At the same time, Malaysia's market has a very strong domestic support. So domestic institutional funds are also coming in to support the market. And KLCR valuations are not expensive. Those are all factors to support our overweight on Malaysia.
Well, today is the signing of the SEZ with Singapore.
That's right.
Any views on that?
So far, things are looking positive. I think they've designated quite a big area to be under the SEZ, and that includes the size of the area apparently is 4 times the size of Singapore. And there are lots of tax incentives that are being offered there.
So a lot of people are talking about Johor being the next kind of growth driver for Malaysia in terms of the next Shenzhen equivalent to Hong Kong versus China as well. Right. That's good. Okay. Ladies and gentlemen, you heard it from the experts here about our views on US market as well as the fixed income market and also in ASEAN and Malaysia. Now, I do think that, the essence of today's call is all about risk management and thinking about building a more global diversified portfolio. Why do we say this? Because we do anticipate volatility. It's not going to be a straight line as we've seen in 2024 in terms of equity markets rising continuously on double-digit returns. So given that kind of view, what then do we do? Now, we do anticipate that you need to build a portfolio of income, you need a portfolio of diversifiers, different markets, and we also think about alternatives out there. Now, when I think about income, I think about my good friend down here who talks about only fixed income. But there are alternatives to fixed income as well out there, right? That clients can actually take advantage of in a volatile market. Can you expand on that idea?
Actually, apart from the traditional income-based investments, which are actually dividend stocks, which can deliver maybe about 4 to 5%, and also bonds, which can deliver about 4 to 6% returns. Interestingly, recently, we came across some potentially appealing ideas about option strategy. And these are what we call call strategy, which can deliver maybe about 7 to 9%. So it looks promising. And it provides a different type of color and also source of income, which can actually add to the returns for the portfolio of the clients who are looking.
Right, interesting. So ladies and gentlemen, look out for a new set of products that we'll be launching soon. We do anticipate that if you combination of equity portfolios with income streams, you do definitely get a very broad diversification strategy. But I do think I want to expand also on alternatives as well. And that is on gold. I mean, gold has been stellar 2024, up 27%, surpassing a lot of people's expectation. Right? I mean, it was about close to about 2,000 odd. Now it's 2,600 per ounce. Right? Where do we see gold going forward in 2025? Is this going to be another multi-year story of double-digit returns?
I think there are 2 strong factors which will support the strength of gold. Number one is, of course, the central banks are buying gold and they are buying in increasing amount. So that actually continued to support gold prices in 2024. And in the past 3 years or so, their accumulation of gold doesn't look to be stopping. So they're building up reserves to diversify away from the strength of the US dollar, which they think maybe because of the geopolitical tension that is going on, it could actually appeal to investors who are looking at safe haven. The other reason why gold has done well is because, of course, US Treasury yields have risen. So basically, has dropped initially, but has risen. But that has actually caused gold prices to continue to appeal because gold has performed better, much better than US Treasury, which is also safe haven.
So in short, what you're saying is that if gold retraces, we should add on more. If you already have it, hold on to it. Right?
Yeah. So we are looking at gold prices currently. It looks reasonably quite neutral for the time. But if we retrace a bit, I think it's good time to add on.
Now, I kind of alluded to uncorrelated assets. The uncorrelated assets really mean basically, ladies and gentlemen, assets which don't correlate with, for example, the US market and so forth, right? And so when you think about that, you think about 2 major markets that has been doing fairly well last year as well. One obviously is Japan and the other one is India. Now, do you have any strong views both these markets as a diversification strategy in case clients out there want to diversify away from a fairly overvalued market like the US.
Yeah. But actually, both of these markets are popular in the global context. If you look at Japan, there are some positives that are going on for it. Firstly, the economy is coming out of deflation. So finally, wages, incomes are all rising. That's driving domestic demand. Secondly, corporates in Japan are also undertaking ROE expansion reforms. They're doing more share buybacks, for example, and that's driving up ROEs. And thirdly, Japanese equities are still quite inexpensive, trading at 14, 15 times PE compared to the US, which is above 20 times. So there are reasons to buy into Japan. India, different.
Is that the assumption that you only buy Japan when the yen is weaker or strong?
Typically, the topics index will tend to do better when the yen is.
Which is where we are now.
It's correct. Especially with the US higher for longer.
Yeah.
So
you mentioned about India as well.
That's right. Yeah. So India, there's a different story there. India basically is already benefiting from China plus one. A lot of multinationals have diversified their risk from China and set up their manufacturing base in India. The other thing is, India's stock market tends to be less correlated to global stock markets. Because the economy is very domestic driven. And finally, infrastructure, I think previously was an issue in India, but that's been improving. And if that continues, that will drive longer term growth for the country as well.
So, ladies and gentlemen, you heard it from the experts here in terms of diversifiers into a global portfolio, Japan, India. We talked a little bit about gold. We also talked a little bit about other streams of income, full options value. So I suppose what we're trying to say here is that 2025, just to reiterate, is going to be a year where it's going to be very interesting. But nonetheless, I do expect volatility to actually start to increase in both asset classes, both in equity and fixed income. And I do think that ultimately, at the end of the day, when we think about US supremacy continue to rise, there's a price to pay. And that is basically a market which continues to be fairly expensive. Now, our view there is that we should only think about increasing our exposure to the US when there's a major pullback or a slight pullback soon. And then we anticipate that. And last but not least, I do also think that in Asia itself, in equities, we need to be selective. China has bottomed out in the short term, but structurally there are still problems. And I think that, as Boon Ho has mentioned, fixed income space is a story of two halves. In the first half, we do anticipate yields to start rising higher. But now when the yields start to rise higher, you should take advantage of it because effectively you will lock in a lot more higher yields. On that note, I want to thank you for your time this evening to sharing with us on our 2025 outlook, Recalibrate with agility. Our theme for this year is to make sure that you are well informed about the risk and the opportunities out there. I also want to take this opportunity on behalf of my colleagues here and CIB to wish you ahead a happy Chinese year, Kong Hee Fat Choi, and a very, very productive and prosperous year in the year of the snake. Thank you very much for your time, and I hope you enjoyed this webinar with us. Thank you.